Hi everybody, welcome to the Attract Capital webinar series. I'm Janine, here with David Barnett, CEO.
Hi everybody.
Today we're going to be talking about the advantage of a one-stop versus two-stop financing deal. So Dave, what is the difference between a one-stop financing versus a two-stop financing deal?
It's a very good question, Janine. In a two-stop deal, you have two layers of loan structure in your deal. You have a senior level and a junior level, otherwise known as the subordinated or mezzanine level. In a one-stop, you only have one level, where instead of having a senior and a subordinated, you just have one. So it really describes how many layers you have in your debt stack and your capital structure.
Great. So then what is the trade-off of using a one-stop financing?
Well, the trade-off is that most people try to go for a two-layer because they can get a lower cost on the senior debt, because the mezzanine debt is a little bit more expensive. And so when you do go for a one-stop, it is, there's a lot of advantages, but it is going to be a little bit more expensive. And a lot of people also think that when you have one lender to the company, that they have a little bit more power over the borrower than you would if you have two lenders, where those two lenders have competing interests, so the company sort of benefits by default. So the trade-off is it's a little bit more expensive and it potentially could be more risky, but our experience is that it really isn't more risky, that there are distinct advantages to doing a one-stop deal.
So can you go a little bit deeper into those distinct advantages for us?
I shall, Janine. I shall go deeper into those distinct advantages. So often when you work with one lender, they can do a larger loan size than you could otherwise get with two lenders because of those competing interests. They're not as worried. If they're the one lender to the company, then they don't have to worry about the senior lender making a decision that would be adverse to them. So you can get a larger loan often. Secondly, the larger size, the fact that you're looking for a larger loan means that you're going to have a wider universe of lenders to be able to select from. Smaller loans means there's a smaller universe of lenders to choose from. So those are two really good ones to start with right there. The fact that they can probably do a bigger loan and you can have more people that are there to provide the loan. You also don't have this intercreditor friction, which is a big thing for lenders. When a lender doesn't have that intercreditor friction, they can develop a better relationship with the company, and over time, they're more comfortable with the loan and they can provide more capital to the company to help them to grow. You could also get better longer-term maturity to repay the loan if you have one lender, which is a very positive thing, because companies need more time to pay back their loans, is our experience, having done this a few times. And it's also, I'd probably say the biggest, most important advantage is that it's easier to close the loan. It is far easier to close the loan with one lender than with two lenders, because each lender will have their own investment decision. They're going to have their own legal process, their own due diligence process. So if you go through one choke point and you have one lender to close, it's going to be more efficient and you have a much higher certainty of closing the deal.
All right, and efficiency is a very good thing.
It is, Janine.
That's what we want.
It definitely is.
Well, there you have it. That's the difference of having one lender versus two. Thank you so much, Dave, and we'll be back in the future with more webinars.
Thank you.